We would like to introduce the portfolio management services from Asit C. Mehta Investment Intermediates Limited, a SEBI registered PMS provider from India.
The most important point of our portfolio management process is the philosophy, the investment philosophy, which depends on value investing principles, which were designed by Warren Buffett and his guru and mentor Benjamin Graham. So let me get into how we go through selecting the companies. The whole starting universe we take is all the companies listed in the market with a market capitalization more than 1,000 crores. So that's the starting universe. Now from that universe, in our opinion, the idea of investing is to gain from the returns on the equity markets. However, when you do that, you're exposed to the equity market risks. And on the concept of don't lose capital, so defining risk in that way rather than in terms of beta or volatility, if you define risk of investing as the chances of losing capital, then you would focus on the risk side of it and think about what are the ways you could lose capital. So the first most important thing, going back to Graham, is that when you're investing in a company, in a stock, you're actually investing in the business. You're becoming a partner in the business. So even for a 1 lakh crore company, if you're buying one single share of face value ₹10, you're still a partner in the company. And you should think the same way if you were going to buy 50% in the company, or maybe in trying to buy up the whole company. So if you go back and think like that, the most important thing becomes that what is the business risk? And based on that, the first principle is to invest only in companies which have a stable business model. What does that mean? That means that either your sales are stable and growing, or your profits are stable and growing. So a stable business model, and that does not eliminate necessarily cyclical companies. It's just that cyclical companies with a stable business model, you have to look at their income statement over a 5-year or a 7-year or an 8-year period, over a full cycle, rather than on an annual basis. So that's the first principle. You need to have stable business model. The rest of the companies are taken out of the further next steps. The second way you lose money is if you invest in stable businesses, but the balance sheet is highly leveraged. So if the balance sheet is highly leveraged and something goes wrong internally or externally, and the company finds it difficult to pay their interest, the chances of equity holders losing capital becomes very high. So that's the second thing. You want to look for strong balance sheets. So that means ideally cash-rich balance sheets. Second preference is zero debt balance sheets. And the third is mild debt. You can think conceptually something equivalent to an international investment grade, which means a A- or better. So very mild debt where the company, even with a 50% or more fall in its cash flows, would still have no problem paying the interest costs. So now you have stable businesses, strong balance sheets. What's the third risk you're exposed to? The value of the company or the business you're investing in comes from the future cash flows. And what the company does, number one, with your current capital. Secondly, how much it generates as cash flows. And then what it does with those future cash flows. So that's where the value of the company comes from. So it becomes important to have a very high efficiency of capital investments. Second point is that the efficiency should be continued on reinvestment of the capital. So the future cash flows also have to be invested at high efficiency. So companies like that are what we call have a persistent advantage. So that's a persistent competitive advantage. And you want it to continue. So you want to look at a track record of a company having a long history of showing high capital efficiency as well as reinvestment at high efficiencies. Why reinvestment matters? Number one, the future cash flow determines your intrinsic value and what the company does with the future cash flows. So just imagine a company has a book value of 100 rupees in its whole lifetime today, and its return on equity is about 25%. So in next 3 years, the company is going to reinvest 100 rupees more in net worth. So whatever the company did in its whole lifetime, it's going to end up doing in the next 3 years. And does the company have the capability to reinvest efficiently in such a short time? So that's what a persistent advantage is. So now to summarize, what you're looking for is stable business models, strong balance sheets, ideally cash rich, and persistent competitive advantages. Now such companies are what we call supernormal companies. Most investment managers stop there and would go and buy supernormal companies. Again, it's not necessarily in such a structured manner, but typically people confuse these supernormal companies with whatever has a great brand. We think that great brand could be associated with a supernormal company, but that's not necessarily a mandatory condition. What is more important is that what the 3 criteria we mentioned, which is stable businesses, strong balance sheets, and a persistent competitive advantage. So all this put together is supernormal companies. And then the most important thing for a value investor is buying a supernormal company at a supernormal price. So supernormal price means discount to intrinsic value. Again, when we say value investing, people confuse with low price to earnings or low price to book. Yes, a supernormal company at a supernormal price sometimes could have a low price to earnings or low price to book. Most of the time it will not have a high price to earnings ratio, but the point is that it should be at a significant discount to intrinsic value. At least 30%, maybe more. Maybe as high as 50% or sometimes even 80% discount to intrinsic value. So when you have such a company, it provides a huge margin of safety to the investment. So to summarize, supernormal companies at supernormal prices is what we invest in. As I mentioned earlier, this philosophy is based on Buffett and his guru Graham. Although you can see that we have done significant innovations beyond that in terms of the process. And with that process, we have the ability to find out supernormal companies at supernormal prices from the whole market. So there are today about 800 odd companies with 1,000 crores market cap and above. And we have that ability to find out these companies from that whole market. So in that sense, it's technology added to the philosophy of Graham and Buffett, and that's the next steps where value investing is going. We have already highlighted the philosophy. The 2 concepts we would like to reinforce of value investing. One is buying something worth intrinsic value of rupees 100 at rupees 70 or rupees 50 or even rupees 20. So that's what typically people understand with the value investing philosophy. The second more important point according to us, which people miss out when they think about value investing, and it's rarely mentioned explicitly, is a risk-averse mindset. And the approach we have shown above of structured value investing, that takes care of the risks you are exposed to or potentially exposed to when you go to equity markets, and our process of mitigating those. You can never eliminate the full risk, but you can significantly mitigate or reduce them. So this is now I'll move to the products, and we basically are focusing on three products or investment strategies. The first one is ACE Multicap. I primarily focused, all my description was primarily focused on that, which is a 25 stock equal weighted portfolio picked up from the 1,000 crore market cap and above universe of Indian stock market. So that's about 800 companies, from which, using the supernormal companies at supernormal prices, we ended up with 25 companies. Within that, again, we put a sector cap so that no single sector is dominating the portfolio, and you have minimum 3 to 4 sectors, possibly many more industries in the portfolio. So that's ACE Multicap. Now moving on to the next product, ACE Allocator. Sometimes there are people who are worried about the portfolio fluctuations, portfolio volatility, and that the equity markets would be in a bubble. And the way to navigate that, if equity markets are at the peak of a bubble, better product, or if a client suspects that equity markets are at the bubble, or he might not remember to move his money out, he's better off, he or she is better off investing in the ACE Allocator. So the construct of the ACE Allocator is based on the fact that from time to time equity markets could be overvalued. Now, how do we define overvalued? We will not look like a typical dynamic asset allocator strategies in the market with mutual funds or other PMSs.